Welcome back. You're watching us here on Halftime Report. Even as the mid-cap index is under pressure, a theme that is doing well is the defense theme. Be it, land, air or water, all the stocks are doing extremely well. We have BEL at the high point, HAL at the high point, and Mazagon Dock doing extremely well as well. So that's the defense theme. But one stock which is on our radar right now is Teamlease. That's after their weakish set of second quarter numbers, where the margins in this quarter had seen a bit of a dip year on year. General staffing growth, however, continues to grow extremely strongly. We do have the management with us. Ms. Ramani Dathi, who's the CFO of the company, joins in. Thanks a lot, Ms. Dathi. We were hearing Ashok Reddy in the conference call, and I quote him. He said that we did enter the year with very optimistic views of a continued tailwind, but there has been a softening in the external environment. Could you give us a sense of what this means in terms of performance for you for the second half on revenues as well as margins? Because for the first half, you're still strong at 32% revenue growth. Can you give us a sense?
Yes. Ashok's comment is specific to IT industry because last 2 years we had phenomenal growth in our IT staffing business. And at the beginning of the year, on the back of our performance over the last 2 years, we increased our investments, increased our teams and the bandwidth, everything. However, starting early Q2, we have seen very strong headwinds and the outlook becoming more and more sluggish. So on top of that, we are also seeing a few other segments like the EdTech and a few other emerging segments. There also we have started seeing some sort of slowdown. So that's where his comment is specifically. However, as you rightly mentioned, in the overall general staffing, we are seeing very strong trends, be it banking, financial services, insurance, retail, e-commerce. So in all those segments, including industrial, manufacturing, we are seeing very strong outlook. However, IT is one segment which is having very strong headwinds.
Okay, so what does that in general mean for, say, specialized staffing revenue? The growth there is slowed down. Of course, as you said, it is largely for the IT segment, and you've spoken about other segments as well. In terms of the headcount, specialized staffing revenue, or what is the outlook looking like?
Yeah. So in our specialized staffing, 80% of our headcount is with IT, only 20% is non-IT. So on the IT front, we are not expecting any growth, be it in terms of headcount or revenue for second half of the year. However, the non-IT segment, we are expecting growth as well as margin expansion. So for full year in specialized staffing, we are forecasting almost a flattish revenue compared to last year. However, there will be an improvement in margins because we are moving to more and more higher margin businesses on our specialized staffing mandates.
Ramani, one of the things which analyst is pointing out is that the unallocable expenses are quite high at about 13 or 14 crores. This was high the previous quarter. You'd given a guidance of that being at about between 6 and 7 crores. It's more than double of that. Could you tell us what is the reason and what's the plan to bring this lower?
Yes. So our unallocated expenses will continue at a trend of 8-9 crores per quarter. So this quarter, what we have done is one of our businesses is on a sunset mode. So we do a small government training business. So since that is on a discontinued mode, so we have moved it from operating segment to unallocated. So that has contributed to almost 4 crore difference on the unallocated EBITDA bucket. Otherwise, that 8-9 crore per quarter kind of trend would continue for rest of the year.
Right. And what about specialized staffing? I mean, the growth out there has slowed down, right? Was the outlook there?
Yes. Specialized staffing will be flattish for rest of the year, and especially because of the IT segment, as I mentioned earlier. However, in general staffing, we are forecasting almost close to a 30% growth year on year in gross revenues. And in terms of headcount, again, upwards of 20% is what we are forecasting. Also, across all of our businesses, now all the investments have been fully absorbed. We are not going to add any further costs for the next few quarters. So we have a clear pipeline in terms of margin expansion and profit expansion for the next few quarters as well.
Okay, so when you're talking about margin expansion, no costs being incurred, no additional costs coming in other quarters, what is the outlook on margin recovery? In Q2 of FY22, you were at 2.24%. It has fallen to 1.62% in the quarter gone by. Will it consecutively improve? What is the outlook here?
Yeah. So we are focusing a lot on absolute profit improvement because in terms of margins, so we are constrained by the inflation in our associate salaries because again, over the last 2 years, so if you look at the salary inflations, they're almost 3 times higher than what it used to be pre-COVID levels. So we used to have about 4-5% of annual inflation in our associate salaries. That number is currently at about 11 to 12%. So that has led to a substantial dilution in our margins. However, having said that, now with the kind of inflation, salary inflation levels being kind of stabilizing, and our internal costs are also being fully absorbed with no incremental investments coming into place. So we are confident of expanding the margins consistently quarter on quarter from here onwards.
Ramani, the net hiring has come in at about 4,700, which is similar to where you were before COVID. Would revenue growth also converge to pre-COVID kind of levels? Could you provide us with some guidance?
It would be higher than pre-COVID levels because whatever interventions that we have made in our clients' approach, vertical-wise, industry-wise approach, so that has started giving us higher pipeline and higher hiring volumes. So in H1, between Q1 and Q2, both put together, we did close to about 18,000 headcount addition in our general staffing. Q2 is slightly lower, but however, on a H1 basis, we did about 18,000 odd, and we'll be doing around similar number for H2 as well. So on a full year basis, we will maintain a revenue growth of close to 30% and headcount growth, year-on-year headcount growth of close to 20-21%.
All right, 20-21% is the headcount growth and 30% is the revenue growth. Take that point, Ramani. Thank you so much for joining in, giving us the outlook. With that, we take a short break. On the other side, we discuss